Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, US proposes a Donbas free economic zone for Ukraine, sparking skepticism and pushing Europe toward a war economy. So we'll discuss why this US diplomatic push is happening now and what it means for European defense stocks and inflationary pressures. Second, China adds more renewables than the world combined, but its green tech oversupply triggers trade friction with the US and Europe. In this episode, we'll break down the green export deflation from China and what it signals for a new era of global trade wars. Third, 24 million Americans face Obamacare premiums doubling as Senate deadlock creates a healthcare fiscal cliff threatening the Fed's soft landing. We'll examine how this legislative gridlock creates a fiscal brinkmanship premium and how it could drive up borrowing costs for the entire US economy. A bombshell report from Kyiv. Ukrainian President Volodymyr Zelenskyy has just revealed a new US plan for the war. Ukraine would withdraw its troops from the Donbas region to create a so-called free economic zone. But this is just the latest version of a high-stakes negotiation. The original US proposal was even more extreme, suggesting Kyiv should simply hand over the parts of Donbas it still controls directly to Russia. Zelenskyy is signaling deep skepticism about this new compromise. His core question, without guarantees, what stops Russian troops from simply taking over the zone after a Ukrainian withdrawal? He stated directly, what will stop them disguising themselves as civilians and taking over this free economic zone? This is all very serious. So what exactly is a free economic zone, or SEZ? It's an area with different economic rules designed to attract investment with incentives like tax breaks. The idea here is to pioneer a new model for post-conflict recovery. Instead of relying on traditional government aid, the goal is to use risk guarantees to attract massive private investment. China's early reforms used a similar model, with the Xiamen Special Economic Zone in 1980 transforming a coastal region into a global economic hub. However, as Zelenskyy rightly points out, the success of such zones completely depends on political stability and security, which is the core of the problem here. The pressure is mounting from Washington. A spokesperson for US President Donald Trump issued a sharp statement saying, "The president is extremely frustrated with both sides of this war, and he is sick of meetings just for the sake of meeting." However, if you zoom out, you'll see this perceived impatience from the US is forcing Europe's hand. It will almost certainly accelerate European defense spending far beyond the current 2% NATO target. This creates a difficult war economy trade-off where governments may have to choose between defense and social spending, and it could fuel inflation in defense-related sectors. We're already seeing this reflected in the market with the stock prices of major European defense companies like Rheinmetall and before anyone else systems surging. Germany's Chancellor, Friedrich Merz, warned it would be a mistake to force the Ukrainian president into a peace that his people would not accept. And the stakes are escalating beyond Ukraine's borders. What really brought this to a head was the huge uncertainty it's creating for global markets. The situation presents a fascinating duality. Markets now have to price in two completely opposite scenarios. On one side, a frozen conflict that continues to disrupt global supply chains for things like wheat and steel. On the other, a massive commodity-intensive reconstruction boom if a real peace deal is reached. This uncertainty is a major driver of volatility in agricultural and industrial commodity prices worldwide. Interestingly enough, for a Chinese-speaking audience, this plan has another layer of implication. A US-backed free economic zone on Russia's border could easily be viewed by Beijing as a strategic challenge. This could prompt a Chinese counteroffer for reconstruction, turning Ukraine's recovery into a new arena for US-China competition. This would effectively force countries and companies to choose between Western-led investment blocks and China's own Belt and Road Initiative, a competition we've already seen play out in Eastern Europe and Central Asia. NATO Secretary-General Mark Rutte just delivered a chilling warning, suggesting that if Russia gets its way, Europe could face a new war within 5 years on a scale not seen since our grandparents' generation. His message was stark. Too many believe that time is on our side. It is not. The time for action is now. We were just talking about the geopolitical chess match in Europe. Now, let's shift our focus to another global arena where the competition is just as fierce, the race for green energy dominance. Let's start with a single statistic that frames the whole climate debate. Roughly 90% of the entire increase in global greenhouse gas emissions since the Paris Agreement has come from just one country, China. But that's not the whole picture. Last year, China added more renewable energy than the rest of the world combined. Their manufacturing dominance has sent the price of solar panels plunging by 90% in a decade. This price drop is a direct result of what economists call green export deflation. You see, China's massive state-backed investment in green tech manufacturing has created a global oversupply. For Chinese-speaking audiences, this is a double-edged sword. On one hand, it's a powerful engine for exports. On the other, this flood of low-cost goods is causing intense trade friction with the US and Europe, who are threatening tariffs to protect their own industries. This could put pressure on Chinese manufacturers in the long run. This is where the situation takes a more complex turn. The real question is, when China builds all these renewables, are they actually replacing fossil fuels or just adding more power to meet rising demand? This is the core issue of substitution versus additionality. After all, if it's only additionality, meaning new green energy is just added on top of the existing coal power, then global emissions won't actually fall. Recent data from the International Energy Agency shows that even as China's solar and wind power surged, its coal-fired generation remains stable. This suggests that for now, it's mostly additionality, which is a major hurdle for global climate goals. This is the central conflict in a global economic battle that's heating up. A staggering $2 trillion has been invested in clean energy, outstripping fossil fuels 2-1, and that $2 trillion figure is more than just a number. It signals that we've reached an inflection point in what's known as the green capex supercycle. This is a massive structural shift in global capital. It's rerouting money away from old energy and creating a new generation of winners and losers across the industrial, materials, and utility sectors. But behind the money, a geopolitical rift is widening. At recent climate talks, rich nations provoked what's described as fury from the global south by hesitating on their financial commitments. To really get a handle on that fury, you have to look at the climate finance credibility gap. Developed nations had pledged to deliver $100 billion a year by 2020 to help developing countries. According to the OECD, they finally hit that target in 2022, but they were 2 years late. That delay shattered trust. This isn't just about feelings, it has real-world costs. This trust gap creates a higher geopolitical risk premium for green projects in the global south, making it more expensive to get private investment and slowing down their energy transition. The chair of the UN's Least Developed Countries Group put it bluntly, quote, "Climate finance to us is not charity, it is a legal obligation." And the rabbit hole goes deeper. At recent maritime negotiations, developing country delegates reported being plagued with intimidatory calls from the US State Department, threatening visa revocations and economic sanctions to block a carbon levy. This confrontation highlights a bigger pattern of policy uncertainty, what some analysts call the Trump whipsaw. The US joined the Paris Agreement, then withdrew under President Trump, rejoined, and then initiated withdrawal again in 2025. This constant back and forth creates massive uncertainty for long-term investors. It encourages other major economies like China to hedge their bets, making global cooperation incredibly difficult. This isn't just about climate policy anymore. This is a high-stakes fight for economic dominance. The Paris Agreement didn't just set an environmental target, it fired the starting gun on a race to control the next generation of global energy. The battle lines are drawn, not over melting ice, but over cold, hard cash and geopolitical power. So, what should we watch for next? Keep an eye on trade announcements from the US and EU regarding tariffs on Chinese green tech. Also, watch the energy consumption data from China and India specifically, where the coal use starts to fall as renewables rise. That will be the true test of substitution. For investors, this volatility means that companies in the renewable energy sector might see their stock prices swing based on policy news, not just performance. The key takeaway is that the transition to green energy is no longer just an environmental story. It's a primary driver of geopolitical risk and market volatility. All market information is subject to rapid change. This is not investment advice. Speaking of policy driving major economic risk, our next story brings us back to Washington, where a legislative failure is creating a financial crisis for millions of Americans. Our final story begins with a non-decision in the US Senate that's about to hit the wallets of more than 24 million Americans with Obamacare. Premiums are on course to more than double at the end of the year. And this is a problem for everyone. Even if you don't have one of these plans, economists call this a healthcare fiscal cliff. Essentially, when millions of households suddenly see their insurance costs skyrocket, They're forced to cut back on other things like shopping, dining out, or travel. This sudden drop in consumer spending acts as a negative shock to the entire economy, complicating the Federal Reserve's delicate balancing act of trying to achieve a soft landing. This isn't a market forecast. It's a direct result of a political stalemate. The US Senate just rejected 2 competing bills aimed at extending critical healthcare subsidies. Both the Democratic and Republican plans failed to get the 60 votes needed, each falling short by an identical 51 to 48 margin, creating a legislative deadlock. The battle lines are drawn. Ahead of the vote, Senate Minority Leader Chuck Schumer issued a stark warning to Republicans, calling it the last chance to act and declaring, "Let's avert a disaster. The American people are watching." But Republicans pushed back hard. Senate Majority Leader John Thune dismissed the subsidies as an attempt to disguise the real impact of Obamacare's spiraling healthcare costs. The White House Press Secretary Caroline Leavitt laid the blame on Democrats, stating the subsidies had completely distorted the health insurance market. Beyond the political rhetoric, there's a hidden economic trap here that affects the job market. Affordable health insurance is what allows many people, especially those nearing retirement or working part-time, to remain in the workforce. According to the Congressional Budget Office, average premiums could jump by over 100% without these subsidies. For a part-time worker or an early retiree, that's a massive financial blow. The risk is that a significant number of these individuals may decide they can no longer afford to work, shrinking the nation's labour pool. This matters because a smaller labour supply could reverse recent gains in the job market, putting upward pressure on wages and making the fight against inflation even more challenging. The last major standoff over this issue triggered the longest government shutdown in US history, lasting 43 days. Now, get this. This kind of political gridlock has a real measurable cost. Wall Street has a term for it, a fiscal brinkmanship premium. When global investors see this level of dysfunction in Washington, they get nervous about the stability of the US, government's finances. To compensate for that added risk, they start demanding higher interest rates to lend money to the US Treasury. The consequence is that it makes borrowing more expensive for the entire country and can deter the foreign investment that helps fund the US government. The irony here is the one thing that isn't deadlocked is public opinion. A recent KFF poll found that 74% of Americans, regardless of party, support extending the subsidies. This has some lawmakers on edge. One Republican congressman, John Rutherford, put the stakes in blunt terms, telling Politico, if we fumble this healthcare bill, nothing else is going to matter. And it's not just politicians feeling the heat. This crisis is also pushing health insurance companies to the brink. The problem is simple. If millions of younger, healthier people drop their insurance because it's too expensive, the remaining pool of customers becomes, on average, sicker and more costly to cover. This is a nightmare scenario for insurers, and some, like Centene, have already reported major financial losses due to rising medical costs. So, what should we watch for next? In the near term, the key focal point will be announcements from major insurers. We could see them begin to exit unprofitable state markets to cut their losses. This would be a huge blow, as it would reduce competition and likely drive prices even higher for those who remain, impacting healthcare stocks. This is the real-world consequence of political failure. Despite broad public support and internal warnings of political fallout, Washington's failure to find a compromise means millions of Americans are now bracing for a massive spike in their healthcare costs.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.